Welcome back. The S&P 500 and Nasdaq hitting record highs this morning as we close out the first half of the year. Joining us now, Apollo Global Management Chief Economist Torsten Slok to give his outlook for the economy in the second half of the year. Torsten, very good morning to you. Good to see you.
Thanks for having me.
Just that snapshot on what we learned there from Kevin Hassett and the developments over the weekend. Is your expectation that the big, beautiful bill ultimately does, whether it's this week or in the coming weeks, does get over the line? And what does that do for your forecast for GDP over the course of the year?
Well, let's just look at it at least as a risk in the near term that we have the one big, beautiful bill, including what the content will be and therefore what it will mean for GDP. We also have, of course, the tariff deadline coming up. And on top of that, we also have the Fed chair decision, which you also asked, of course, Kevin, about. So the issue here is that there's still a number of things on the horizon where you could begin to worry about. Well, we have probably peak uncertainty behind us, but there's still a number of things on the forward-looking horizon where you need to think about what does this mean for markets.
Which of those things is your biggest risk factor?
So the biggest thing that we worry about is really still the issue about trade. So if we raise in the bill $400 billion in revenue from tariffs, we are having the pig coming through the python here. We need to think about who is going to pay that $400 billion. Is consumers through higher inflation, or is it earnings? Earnings for the S&P 500 last year was about $2 trillion if you accumulate everyone all combined. So $400 billion out of that, that means that it's 20% of last year's earnings. If it is companies that are eating the tariffs, that will have a fairly significant negative impact on earnings and therefore on growth over the coming quarters, if it is the case that inflation is not going up.
I mean, he is banking on 3% growth and said that that's why this is not going to be fiscally irresponsible, this bill.
Well, the consensus view is that GDP growth over the next several quarters, of course, will slow down. That's also the CBO view, that's the Fed's view, that's our view. So yes, there might be coming some GDP growth lift eventually, but it's very clear the consensus view is not that GDP growth is going to accelerate. It is that it's going to slow down, partly because of tariffs, but also because of some of the other headwinds, student loan payments restarting, beginning to become an issue for consumption. All those things are probably the reasons why the consensus has that growth is going to slow down over the coming quarters.
Are you still stagflation guy?
I'm still stagflation, coming from the simple idea that if we raise tariffs by $400 billion, either you get higher inflation or you get lower earnings. So that means either
we're not getting either right now.
So Jay Powell said last week and the week before that he expects a meaningful increase in inflation over the coming few months. That's very strong words to come from the Fed chair.
What is your view? We were just talking about how much you travel and see clients all around the world. I mean, what is your view on the dollar and whether it's odd? It hasn't really shown up in the number for Treasury holdings, for foreign holdings of U.S. stocks. But do you think under the surface there is a change in sentiment towards the U.S. dollar and U.S. holdings or not?
I think with Section 899 behind us, I think the outlook for the dollar for the second half is much brighter. If you look at what's been going on with the dollar for the last 6 months, it's been going down 10% in trade-weighted terms. And at the same time, the S&P is at all-time highs. IG spreads are very tight. High-yield spreads are very tight. It's very clear foreigners are not selling U.S. assets. So, and that was also what we saw in the tick data that came out for April. Yeah. So that's why the conclusion is it doesn't seem like this was something driven by asset sales. The key reason why this happened, in my view, was because of hedging. And that hedging activity is likely going to be much less now that Section 899 is behind us.
So do you think that the Fed the pricing for Fed cuts this year is too aggressive?
I think it's too aggressive. I think rates will be higher for longer. And I think that...
do you see, so that, what's the pricing now, 2?
So I only think we'll have one cut this year. It will be very, very difficult with Jay Powell. The committee, the 12 members who vote, will have a very hard time arguing why they should be cutting as quickly as the market is pricing.
You don't think we're going to see a weak jobs number at some point?
Well, so far, of course, jobless claims have still been okay, continuing claims up a little bit. So broadly speaking, the labor market is still holding in quite well. We'll see on Thursday when we get the number.
So can I just come back on the dollar? Because when you see the president tweet, and maybe he doesn't get his way in the short term, and I know that's everyone's expectation, and Powell finishes out his term, but he is tweeting so clearly and aggressively, I'm only going to appoint someone who wants to see rates down at 1%. I mean, how is that not bearish for the US dollar? Or so you think we're going to have a short-term bounce, or do you think this is the low on a 3-year view for the dollar?
Well, I think very importantly that any decision by the Fed is done by the committee, and there are 12 voting members, and they vote not only on interest rates, they also vote on QE. So that means that it is the committee that decides what needs to be done. So in that sense, the Fed chair, of course, it's a very, very important job, but it is not the veto job that some people make it to be, that the Fed chair can decide everything that happens. So that's why the committee will need to agree with the view that the cuts are needed. So it could be a very, very unusual situation where the Fed chair has voted down, 11 members saying, no, we don't want to cut rates, and the Fed chair saying, I would like to cut rates.
Really, really interesting. Final question for me is on like the global growth outlook. So often the US has outperformed to the upside. If you're right, if the consensus is right, we go down to the 1%, 1.5% in the next 12 months. Do you think other countries can outperform, or actually is everyone slowing down a little bit and we might well have a very tepid 12 months ahead of us?
I think especially Europe has some lift, especially spending $500 billion on infrastructure and unlimited on defense. But broadly speaking, the US is still exceptional. The Draghi recommendations, 170 points. We are barely moving on many of them. So the conclusion is the growth outlook for the US in the longer run continues to be stronger. That's why the US will remain exceptional. And that's why the dollar is now having a much brighter outlook for the second half of this year than it had when we had Section 899 in the One Big Beautiful Bill.
Really interesting. As always, Torsten, much appreciated. Great to see you.
Thank you.